Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Chiang. Hello, and welcome back to the Grow Your Wealthy Mindset podcast. I hope you're having a wonderful spring and have some travel plans to look forward to over the summer if that's what you do. I know I'm traveling a lot this summer and I'm really looking forward to my trips. Today, I'm going to go more into index fund investing. Index fund investing is the best way to invest in the stock market. I used to spend time and energy researching different companies and buying individual stocks, but honestly, I haven't bought an individual stock in over 15 years. To me, investing isn't about chasing the best market returns. It's about growing my wealth and doing it in a consistent way. And there are so many great reasons to invest in index funds. A single index fund can provide great diversification. Index funds are highly liquid investments. You can sell shares the next business day and really have cash in your hands if you need it within a few business days. Index fund investing is completely hands-off. You don't really have to do much. You can rebalance once a year, but you honestly don't even necessarily have to do that. You can be totally off the grid, knowing there's nothing you have to do with your index funds, which is very different from being an active real estate investor. Index fund investing also has really low costs, and so those costs don't erode into your investment returns. It's really tax efficient, and we physicians certainly don't need to be paying any more in taxes than we already do. You can buy an index fund in a taxable brokerage account, and you're really not going to pay taxes on anything except the dividends until you actually sell. And as long as you hold that index fund for at least a year, then you're going to pay the capital gains tax rate as opposed to the earned income tax rate. So that could be as low as 0%, but for most of us physicians, it'll be 15 or 20%. I've talked about index fund investing many times on this podcast. In episode 16 of this podcast that was released back in September 14th, 2022, I do go into detail about exactly what it is to be an index and what is an index fund. I talked about how to get started investing in index funds in that episode as well. If you haven't listened to that episode, I would really encourage you to do so. What I didn't talk about in that episode is what makes a good index fund and how to choose which index funds to invest in, specifically if you can't invest in a Vanguard or Fidelity index fund, which are the funds that I mentioned during that episode. If you are investing in a taxable brokerage account or your Roth IRA or any account where you can choose the brokerage firm it's held at, I do recommend sticking with Vanguard, Fidelity, or Charles Schwab. These are all low-cost brokerage firms with a good selection of low-cost index funds and relatively good customer service. Most people will do great investing in an S&P 500 index fund or a total U.S. stock market index fund or a total international stock market fund and or a total U.S. bond market fund that's sponsored by any of those three companies. You could do a traditional index mutual fund or an ETF. Choose the index funds that represents the asset allocation that works for you and make your investments with Vanguard, Fidelity, or Charles Schwab. I have no financial interest in any of them, and I do have accounts at all three of those brokerages. For more on asset allocation, go back to episode 37, choosing the right asset allocation for you. That episode was released on February 8th of 2023. What I really want to address in this episode today is how to choose an index fund investment in your employer-sponsored retirement account if it's not held at a place like Vanguard, Fidelity, or Charles Schwab. If you work at the VA, then you'll have the TSP funds as your only options. And those are actually decent options, and those are fine. They have different funds for the different asset allocation classes. However, depending on where you work, you may find yourself with a company like Voya, TIAA-CREF, or another plan sponsor for your 403b or 401k. Your plan sponsor may offer Vanguard index funds even if it's not at Vanguard, and if it does, that's great. You can certainly invest in those Vanguard index funds. But if that's not something available to you, then I want to go over today what makes a good index fund so that you can confidently choose where to invest the money in that retirement plan. The first thing is that the index fund should have low fees. Lower fees means more of the fund's return goes to an investor. The fee that you're going to look at is the expense ratio, which is the annual fee that investors pay to the fund, and it's generally expressed as a percentage of assets. Typical index fund expense ratios can range from 0.03% to 0.2%. That's the range of the Vanguard and many of the Fidelity index funds. Fidelity actually has a class of zero index funds where literally Fidelity is subsidizing the cost of running those funds, and there's a 0% expense ratio. That being said, I've looked at people's employer-sponsored retirement accounts, and even index funds that look like real index funds in there may have an expense ratio as high as 0.5%. So it may be not possible to find something as low as 0.2% depending on your employer-sponsored plan. You also want to check that there's no marketing fee and no commission or load fee. Generally, there's really only going to be a commission or load fee if you're buying a fund through an investment advisor or financial advisor or a broker. That commission or load fee is actually the payment that that broker or financial advisor is getting paid in order to sell you that fund. Index fund investing has low costs because you're not paying for a team of analysts who are researching companies. When you think of an actively managed fund, they're going to have multiple people who are all likely being paid six figures, as well as all their equipment and costs to research different companies in order to decide what assets or companies to buy within that fund. Index funds don't do that. Index funds are following an index, and so they're just buying the companies that are on that index. They're not researching and deciding which companies to buy and sell. They're buying and holding companies on an index. So index funds really should have very low expenses. It's really a buy and hold strategy. The next thing you want out of an index fund is to make sure that that index fund's performance matches the index it's tracking. You can do this by Googling the ticker symbol for the fund and then click on Compare and look down to choose the appropriate index you want to compare it to. If you look at VOO, Vanguard's ETF for the S&P 500 index fund, and compare its performance over the last year compared to the actual S&P 500 index, you'll see that the two graphs are literally on top of each other. If you now compare the last 10 years, you'll notice that the shapes of the graphs are the same, but that VOO is actually giving higher returns compared to the S&P 500 index. This is because with VOO, the actual index fund, the dividends are actually being reinvested. So the value of that investment or any investment you make in that fund does actually grow higher than if you look at the S&P 500 index itself, because the S&P 500 index is calculated without reinvesting of dividends. The way these comparison graphs work is that they have the same starting point, and then small amounts of improved performance will show up as better returns over time. And this also shows just how those incremental investments by reinvesting dividends really also adds to your return. Now, if you're actually doing this exercise and you compare the RIDEX S&P 500 index fund that has the ticker symbol RYSOX, then you will see that RIDEX underperforms the actual S&P 500 index fund. This is an example that not all S&P 500 index funds will actually do a good job of tracking and matching the performance of the S&P 500. And there are multiple reasons that can cause poor tracking. One can be economies of scale. When you have a smaller fund provider and they have lower assets under management, then they may have less efficient operations, so they may struggle to replicate the index accurately. The other thing that can cause poor tracking is something called cash drag. So some funds will hold cash for redemption or operational purposes, and any cash that they have is not producing the same return on investment whenever the market's going up. Now, if the market's going down, having cash may be actually better, but more often the market is going up than it is going down. So the more cash on hand, that cash isn't increasing in value like the investments. Along the same lines of cash drag is dividend timing. So if a fund does receive dividends but doesn't reinvest it quickly enough, that also adds to that cash drag. There can also be rebalancing lags, which is a delay in rebalancing when the index changes. So you imagine the S&P 500 index has 500 companies that's chosen by the committee at Standard & Poor's who creates this index. They review the companies on the index quarterly, and there are companies that will end up being removed from the index and a new company being put on the index. You can imagine when a company falls off the S&P 500 index and a new one is added, that there's going to be a lot of trading volume selling the company that fell off and buying the company that's added because there are so many S&P 500 funds out there. It's even possible that the announcement of the change alone affects the share price of the stocks. So if Standard & Poor announces, okay, they're dropping company A and adding company B, company A's shares are going to drop. And so an S&P 500 fund who doesn't sell quite immediately will end up selling with the share price dropping even further and then having to buy company B, whose stock is probably actually increasing in value as all the S&P 500 funds out there are buying it. This is one of the arguments some people make to invest in a total US stock market fund as opposed to the S&P 500 index fund. Of course, those two funds are not actually representing the same asset allocation. The S&P 500 are large cap stocks. The US total stock market has large cap, mid cap, and small cap stocks. When it comes to the performance of an index fund, you want the fund performance to really match the performance of the index. Something I want to point out is if you look at Morningstar ratings, what they do is they measure the fund's past returns compared to the peers in that same Morningstar category. So a 5-star fund is in the top 10%. If they have 4 stars, that means they're in the next 22.5%. And then 3 stars is the middle 35%. You can actually have many great index funds that fall into that 3 or 4-star category. And many of them aren't going to have 5 stars because the top 10% of funds in a category might actually be actively managed funds. Around 35 to even up to 50% of actively managed mutual funds will outperform the total US stock market in a given year. The thing about actively managed funds is they don't tend to continue to outperform the overall market year after year. Only about 20% of actively managed mutual funds will outperform the total US market consistently over a 5-year period. And only about 10% of actively managed mutual funds will outperform the stock market over a 10-year period. That means investing in the overall US stock market will let you outperform 90% of actively managed mutual funds and without the expenses associated with investing in those funds. And if you're choosing a fund because they've been outperforming in the past, that doesn't mean they're going to continue to outperform in the future. So once they get to that 5-star rating, in a few years, they may no longer hold that 5-star rating. Remember, index funds seek to match the market, not beat the market. A good index fund also has a low turnover rate. The turnover rate is the measure of how often a fund buys or sells assets. The strategy of a good index fund is really to buy the companies on the index and hold those companies, which really means a low turnover. High turnover can result in higher transaction costs, which leads to higher expenses. High turnover results in capital gains distributions, which can also affect returns, especially if you're holding it in a taxable account. When you're evaluating an index fund to see how good it is, you want to see that it has a really low turnover rate, generally something less than 10%, which means less than 10% of the funds have been bought and sold over the year. If you see a turnover rate of 100%, that basically means that every single company in that fund could have been sold and repurchased, or a different company purchased within that year. A 200% turnover rate really means that they're churning through all the companies they're buying and selling, buying and selling. Generally, you'll also want to buy index funds that gives you good diversification over the asset class or sector that it represents. You want to invest in a wide range of assets in order to spread risk. This reduces the impact of a poor performing asset into the overall portfolio. There are times that you may want to invest in a specific sector, like maybe you're really thinking technology is going to do well, and so you're going to invest in an index fund that just invests in the technology sector, then it should really be holding many companies that all represent the technology sector. Now, there may be some sectors that have less companies, but whatever index fund you're investing in, you want to make sure it's well diversified. And of course, when you're doing business with anyone or any company, you want to do it with a reputable company. That's also true with index funds. When you invest in an index fund family, you want it to be managed by a reputable fund advisor. That would be a company with a long history and a commitment to low-cost investing. Ideally, it also has a large investor base so that there are economies of scale. Vanguard is really the leader of index funds. They are the first to actually put out index funds available for consumers to invest in. But I've also already mentioned Fidelity and Charles Schwab. In your employer-sponsored retirement accounts, you may also see index funds from BlackRock, which are the iShare funds. And these are also known to be good low-cost index funds. Unfortunately, not all index funds are good index funds. I previously mentioned that RIDEX S&P 500 index fund. Well, I'm going to compare it a little bit more. The RIDEX S&P 500 index fund, if you look at the expense ratio, it's 1.62%, which is actually higher than a lot of actively managed funds, which often fall in the 1 to 1.5% range. In comparison, VFIAX, Vanguard's 500 index Admiral shares, their traditional mutual fund has an expense ratio of 0.04%, and VOO, Vanguard's S&P 500 ETF, has an expense ratio of 0.03%. The turnover rate on that RIDEX S&P 500 index fund is 243% as of March 31st, 2024. Compare that to a 2.2% turnover rate for Vanguard's S&P 500 index fund, both their traditional and their ETF. If we look at the total net assets of the RIDEX S&P 500 fund, it's $253 million, which is a lot of money, but compared to Vanguard, which has over $500 billion in each of their index funds, it's really not even comparable. Vanguard's funds don't have any fees other than their expense ratio, whereas this RIDEX S&P 500 fund has a front load fee of 4.75%, a management fee of 0.75%, and a 12B-1 fee of 0.25%. So of course, I looked for a really terrible S&P 500 index fund as an example for this podcast episode. But it's to let you know that those bad index funds are out there, and you definitely want to avoid investing in one of those. So when you're looking at investments, you want to look beyond the name of the fund. Just having the word index in the fund is not enough to say that this is a good investment. And in fact, I've seen funds with the name index in it that aren't even index funds. So how do you know if a fund's actually an index fund? What you want to do is read the investment objective. If you see the word outperform, then it's not really going to be an index fund. An index fund is supposed to match the market. So the investment objective should read something like, the investment seeks to track the performance of the blank index that measures the investment returns of blank index, or something like, invest in the stocks of the blank index. Goal is to closely track the index's return. Or it may say something like, the investment seeks investment results before fees and expenses that correspond to the return of the blank index. If it says something like, the investment seeks to outperform the total return performance of the blank index, then it's not an index fund because it's really trying to outperform as opposed to track or match. So when it comes to index fund investing, the first thing to do is to choose your asset allocation. That's the percentage that you want in different sectors. That could look like investing in 50% of the US total stock market, 30% total international stock market, and 20% US bond market. Or you can get more granular and decide how much you want in US large cap, US mid cap, US small cap, international developed versus international emerging markets. You may also decide that you want to invest in international bonds as well. Whatever it is your asset allocation, that's what you want to set first. If you're overwhelmed by asset allocation, it's totally fine to start out with 80% total US stock market and 20% US bond market. If you want to be more conservative, you can add in more bonds. But again, I really recommend listening to the podcast episode specifically on asset allocation. Once you've picked your asset allocation, then you're going to find index funds that follow the indexes that match that asset allocation. Look at the fees, the turnover, and how well the fund tracks the actual index that you're looking to follow. And then once you find something that has a low expense ratio, something ideally less than 0.2%, but as low as you can find among your options, a low turnover, ideally less than 10%, but again, as low as you can find within your options, and something that's tracking the index fairly well, then go ahead and make that purchase in your employer-sponsored retirement account. Now remember, most physicians will need to invest more than they can put in their employer-sponsored retirement account in order to actually fully fund their retirement. So you're also hopefully investing in a backdoor Roth IRA, as well as a taxable brokerage account. Depending on what funds are available in your employer-sponsored account, you just want your entire portfolio to match your asset allocation. You don't have to have your employer-sponsored retirement account specifically match your asset allocation. So if there's, for example, maybe no good bond funds in your employer-sponsored retirement account, you could invest just in US stocks and then invest your Roth IRA in a bond fund. Let me know if you have any questions about choosing an index fund for your portfolio. You can email me those questions at growyourwealthymindset@gmail.com. I'd love to hear from you. I'd love to hear what your questions are, so that helps me know how I can teach this material better. And if you do like investing in individual stocks, I'm not against that, but that should be a small percentage of your portfolio. I would say less than 5%, but I would keep the rest of your stock portfolio in index funds. When it comes to bonds, some people do like to buy their bonds directly from treasurydirect.gov and buy US government bonds, and that's totally fine. But when it comes to stocks, I really recommend you investing the bulk of your portfolio in low-cost index funds. If you could use some help picking out investments within your employer retirement account, that's something that you could hire a fee-only financial advisor to do. I'm not a financial advisor, but I am also willing to help you look through your options and teach you how to choose for yourself. If you'd like to be a more do-it-yourself investor and really be hands-on but need a little hand-holding, that's where I can really help you. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast, and I'll be back next week with another episode. Until then, take care. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.